Here's a quick question. What do these items have in common? Writing a symphony, brewing beer, flipping burgers, designing handheld furniture, passing the bar exam. The answer? They've all been accomplished by AI technology in the last year. As we kick off our latest market update, we certainly have AI on the brain, and we can discuss how we're investing in it for our clients. But first, let's summarize what we saw this year, take a glance at what's coming in 2024, and then finish out with the key opportunities on the horizon, AI included. First, let's talk about 2023 with a specific reference to the S&P 500. This year has been a typical year in the late cycle. A lot of up and a lot of down, landing in the same place. Inflation is being stubborn and sometimes feel like it's Groundhog's Day. But we also have what we call a tale of two cities. One with 7 residents and the other with 493. Now you may be aware that the S&P 500 consists of the 500 largest companies listed on the U.S. stock exchange. What you may not know is year-to-date through Q3, the average unweighted return of 493 of those companies is just under 3%. Meanwhile, the average unweighted return of the remaining 7 up over 87%. If your investments were not exclusively in these select stocks, you probably trailed the index. And yes, while that strategy would have worked for 2023 so far, too heavy of a concentration in those stocks is not what you want long-term from a diversification and an asset allocation perspective. So now, let's take a look ahead to 2024. At some point next year, we expect the recession stage will officially start. Late cycle turns into recession stage and then is followed by the recovery phase. When people think recession, they think market losses. But that isn't always the case. If you will recall, the market is always looking ahead 1 to 2 years. We believe that the market saw a recession coming and has already accounted for it in the difficult markets we saw in 2022. We expect this recession will be milder than the ones etched in our memory over the last 23 years. In fact, historically, mild recessions are much more common than the big crashes like the COVID pandemic, 2008, 2009, and the dot-com bust. The thought of a recession may seem daunting, but keep in mind from both historical and glass is half full perspective, a recession is always followed by a recovery phase. Historically, recoveries see a reduction in rates, which spurs activity. Businesses can borrow and grow. Consumers are more likely to spend money. Cash earns less, so people want to use it to invest again. The recovery phase has historically produced the best returns of any phase of the business cycle, and that will be just around the corner. Now, with that, I'd like to introduce Oakenstone's model manager, Seth Diener, to discuss recovery and the opportunities it presents. Seth?
Thanks, Joe, for the introduction. Let's start with artificial intelligence. Many believe that artificial intelligence will be among the most significant technological advancements of our lifetime. Let that sink in. We've had some pretty good ones the past 20 years. Bill Gates even said, AI is as fundamental as the creation of the microprocessor, the personal computer, and the internet. Wow. AI is poised for unprecedented growth. Its market is projected to reach a staggering $407 billion by 2027, after an estimated $87 billion in revenue in 2022. Among the fascinating trends we see with AI is its incredible speed of adoption and variance in use across so many industries. In simpler terms, fast growth and widespread adoption. ChatGPT, likely the most famous consumer AI tool, garnered 1 million users in the first 5 days of its release, and 100 million in the first 2 months. That's incredible. That's more than double the adoption rate of both tablets and smartphones. And businesses are buying into it. A significant 64% of businesses believe that artificial intelligence will help increase their overall productivity, with significant applications growing for healthcare, manufacturing, hospitality, IT services, and more. Even small businesses have adopted, with 90% of small businesses saying that AI has already made their company successful. We believe the companies and industries that are quickest to adopt AI into their business model will achieve efficiencies and profitability inconceivable previously and will be the catalyst for the next bull market. That's why we're currently investing in AI through industry leaders like Google, Microsoft, and Meta. We're also taking it one step further by investing in companies that make the chips that power nearly every major AI program. So that's our update on equities. But where do we stand with bonds? This one's pretty simple, as we feel we're in the same place we were last time we provided a market update in April. To summarize, we think that bonds are poised for a nice year in 24, especially if interest rates drop. I would recommend you check out our spring update for a full review on bonds and what to expect. Thanks for taking the time to catch up with us, and we hope that this gives you some valuable insight. To stay up to date on the latest research, be sure to follow us on social media or register to receive our weekly market commentary every Wednesday. As always, stay strong, stay smart. Until next time.